I know that you had, so I think you took a small stake. Take me through that process of you ended up taking a piece of somewhere.com. Take me through that and into then obviously eventually acquiring more than half the business.
I think when you're like, there's two advantages you have early on as a founder. Like if we back up, the competitors, the in-place businesses have almost every advantage. They have the brand, they have the money, they have the network, they have the employees, they have the marketing, they have everything in place to run a big successful company. You as a startup have almost no advantage. You have two. Number one is you can move faster than them. You can like move very, very quickly. You can make a decision in the morning and that can be it can be in place inside your company before lunch. Big companies can't do that. Yeah. And another thing that many, many companies in America don't quite do yet is they grow with international talent for 70% lower cost. So those are two things that you can do to start to grow your company. Those are the two things that I do. But I made those first couple hires and I was like, damn, this is a really good business. Marshall said, okay, why don't you start talking about it to your friends and talk about it on Twitter and I'll do a revenue share with you. You know, a couple months later, I was making 20, 30 grand a month talking about somewhere on X. And a year after that, the company had 5x'd in size, doing $250,000 a month of revenue. And I was like, dude, I want to own some of this thing. And so I bought in 15% ownership stake. Wish it was a lot more. And then, a year later it was $600K a month of revenue. Year after that, it was $1 million a month of revenue. So crazy journey.
Tell me more of that, just in terms of thinking through the rev share versus the kind of owning equity in the business, your thoughts on that and why 15%? Why wasn't it 10? Why wasn't it 20%? Why wasn't it 5%?
Well, Marshall wanted to do 5. Marshall wanted to do 5 and I wanted to do 30. And it was a negotiation, obviously. So
like, all right.
Yeah, but I was at least smart enough to know that, hey, I'm not going to talk about this business anymore unless I own part of it. So I'm either going to go start my own company or I'm going to get involved in this one. So it was a win-win for me and Marshall. It's been a life-changing deal.
Let's talk about the deal. We'll just get right to it. You actually buying somewhere. Take me more of that, because you had to basically outbox Andrew Wilkinson, I think it was, for this deal. Like, how did you end up getting the deal?
Yeah, and look, Andrew Wilkinson didn't have a signed offer on the table. It was vocalized as something that he wanted to explore. But Marshall calls me in the fall of 2023 and says, "Hey, like, I got an offer to sell 51% of somewhere for $47 million." And I'm like, holy shit. But it makes sense. Like, I'm looking at the numbers, like that makes sense. And he goes, "Do you want to sell half your shares? I own 15%. Do you want to sell half your shares?" At that number, I'm doing some math. I'm like, holy shit, that's more than $3 million. That's not generational wealth. It's not like I never have to work again, but that's life-changing money from a kid from small town Southern Indiana.
Absolutely.
But then I kind of talked him over the next couple of weeks into selling the business to me instead of Andrew Wilkinson. And the business, over the next couple of months, the business grew. I mean, when I told him that, his first question was like how, Nick? Like, I like you and all, but like, where are you going to come up with this money? How are you going to put the deal together? He had a lot of questions, and I didn't know the answer, but I figured it out very quickly. We ended up striking a deal, and what I was trying to solve for was, hey, how can I, Sean Puri had come in as an investor, so I'd been diluted down to 12.75%. How can I do a deal where I get enough upside to make it worth it for me to raise a bunch of money, put this whole deal together? And I realized very quick, in the private equity world, the money calls the shots, especially when it comes to operating companies. Like with real estate, there's a building there. There's a physical asset. This business, we had 3 Americans and a bunch of people in the Philippines and Latin America and South Africa. So it's a risky deal. It's a new business. Of course, it's growing fast. It's got a lot of tailwinds, but it's a new business. And so a lot of the investors said, "Hey, I'll give you some money, but like, I'm getting the majority of this upside," rightfully so. So I realized that I could raise a big chunk of money, but after I get all these investors paid back, I can't really justify more than about 20% of the upside from there for Nick. So if I go buy, 57% of the company and raise all the money, this is kind of my thought process. 57% times 0.2. I get an additional 11.4% equity if I do that deal and I get and it's a huge win. So 11.4% plus 12.75. I own 20, 22, 23% of the company. Is it worth putting my name on the line, raising $40 million to do that? No, it's not for me. That just wasn't worth it. So I had to think of a different way to structure it. So we did a 39% of the business in a private equity tranche where I raised $20.3 million from 39 people, average check size a little over $500,000. Marshall got that cash at closing. And then an additional 18% of the business I bought from Marshall in the form of a seller note directly to me outside of the private equity tranche. So if I get that seller note paid back and I get all my investors paid back, I'll own about 39% of the company. It's all said and done.